Welcome to Talk Tickers. We're your shortcut for getting up to speed on important earnings calls. Today, we're jumping right into Hanmi Financial Corporation. Their first quarter results for 2025 just came out.
That's right. And we're here to basically pull out the key takeaways, figure out what management's saying, and just give you the essentials from that call.
Exactly. Let's start with the big picture, the results snapshot. How did Hanmi do overall in Q1?
Well, it looks like a pretty strong start to the year, actually. Net income saw a nice jump, up 17% compared to last year. That came in at $17.7 million, or about 0.58 per share. So a 16% increase there on a per share basis.
Okay, 17% income growth. And what about profitability metrics, things like return on assets?
Yeah, those looked healthy too. Return on average assets was 0.94%, and return on average equity came in at 8.92%. And, something that really stands out is the net interest margin.
Ah, yes, the NIM. Always key for a bank.
Right. And they actually saw it expand for the third quarter in a row. It went up 11 basis points to 3.02%.
Third consecutive quarter of margin expansion. That's definitely notable, especially in the current environment. What's driving that?
It really seems to be about managing their funding costs. They mentioned their deposit interest expense dropped.
Dropped by how much?
By 6.6% compared to the last quarter. And the average rate they're paying on interest-bearing deposits, that fell 27 basis points. It's down to 3.69% now.
Okay, so they're paying less for their deposits. That makes sense.
Exactly. And while their average loan balances did tick up a bit, about 1.4%, the actual yield they got on those loans dipped just slightly, like 2 basis points down to 5.95%.
So the benefit is really coming from the funding side, the deposit costs.
Precisely. And they do expect a bit more margin expansion next quarter, Q2, because they have some higher cost CDs maturing that they can hopefully reprice lower. They mentioned an average rate of about 4.41% on those maturing CDs compared to a March spot rate of 4.1%. So still some room there.
But they expect the pace of that expansion to slow down.
Yeah, that's the guidance. It'll likely moderate a bit. Still positive, but maybe not expanding quite as fast.
Got it. Let's talk about loans. Growth was pretty modest, right? 0.5% linked quarter.
Yeah, just 0.5% growth, bringing the total portfolio to $6.28 billion. But interestingly, their production of new loans was actually up 2% from Q4.
Oh, okay. So they originated more loans in Q1.
Right, about $346 million in new loans, and the weighted average rate on those was 7.35%.
Where did they see that production growth?
Mostly in residential lending, SBA loans, and also equipment finance. On the flip side, C&I lending, commercial and industrial, that was down a bit.
Yeah.
And CRA loan production was basically flat.
What about commercial lines of credit? Any movement there?
Yeah, an interesting dynamic. The total commitments for lines of credit actually went up, but businesses drew down less on those lines.
So utilization rates fell.
Exactly. Utilization was lower. And their USKC loans, the ones tied to their US-Korea consortium clients, those balances held steady at around 15% of the total portfolio.
And looking ahead, what's the pipeline like for Q2?
Seems pretty healthy for Q2, but management did flag potential headwinds for the second half of the year.
Headwinds like what?
General economic uncertainty, and they specifically mentioned tariffs as a potential factor that could soften loan demand later on.
Tariffs are always looming. How are their clients, especially those USKC ones, feeling about that?
Well, according to management, those clients, especially the ones in the auto sector, seem pretty well prepared. Apparently, they've already taken steps based on past tariff noise.
Okay, good to hear. Let's switch gears to the other side of the balance sheet, deposits. You mentioned lower costs, but how was growth?
Deposit growth was actually quite strong, up 3% in the quarter.
Wow, 3% is significant. What fueled that?
It was mainly new commercial accounts plus contributions from their newer branches, but the really eye-popping number was deposits from their corporate Korea clients.
Oh yeah, what happened there?
Those deposits saw a massive increase, like 166% compared to Q4.
166%, that's huge.
It really is. That segment now makes up 15% of their total deposits. And even more, 17% of their demand deposits, the non-interest checking type accounts.
So that USKC focus is really paying off on the deposit side.
It certainly looks that way. And non-interest bearing deposits overall are still holding up well, around 31% of the total. They also mentioned successfully retaining about 88% of roughly $680 million in retail CDs that matured in Q1, and they repriced those lower.
So strong growth and they're managing costs. That's a good combination.
Definitely suggests a strong customer base and maybe some effective relationship banking, especially with those corporate Korea clients.
Okay, let's pivot to asset quality. Any concerns there? How are the loans performing?
Overall credit quality seems to be holding up pretty well. The allowance for credit losses was stable at 1.12% of loans.
So the buffer for potential losses is steady.
Right. There was a small increase in the provision for credit losses, though, basically the expense they took this quarter.
Why was that?
It was mainly due to one specific CRA loan being downgraded to non-performing status. It's part of a larger syndicated deal, a commercial real estate loan on an office property in a central business district. Apparently, the borrower and the lead bank haven't agreed on renewal terms yet.
How exposed is Hanmi to this particular loan?
Their share is relatively small, just 10% of the $200 million total loan, and they've already set aside a $6.2 million specific reserve against their piece.
Okay, so they've provisioned for it. What about their overall syndicated loan book or office CRE exposure?
Their total syndicated book isn't huge, around $255 million. And they are watching over $200 million in office CRE loans that mature this year in 2025. But management said on the call that they don't currently foresee any major issues with those maturing loans.
Okay, so one specific issue, but generally stable asset quality. That sounds manageable.
Yeah, that seems to be the picture for now.
What about the other parts of the income statement? Non-interest income and expenses.
Non-interest income got a nice 5% boost, mostly, as you mentioned earlier, from selling SBA loans. Good gains there.
Right. And expenses.
Non-interest expenses did tick up slightly, about 1.3% from Q4, but that was mainly because Q4 had a one-time gain that wasn't repeated. So even with that slight cost increase, because revenues were up more, their efficiency ratio actually improved. It came down to 55.7%.
Better efficiency is always good. Any expense guidance for Q2?
Yes. They flagged a likely 3 to 4% increase in salaries and benefits for Q2. That's mainly due to standard annual merit increases and promotions kicking in. Pretty typical stuff.
Makes sense. And how about capital? Returning cash to shareholders.
They were active there. They bought back 50,000 shares during the quarter.
Do you recall the average price?
Yeah, it was $22.49 per share. And the board is going to keep looking at dividends and buybacks each quarter. Their tangible book value per share also grew, up 2.6% to $24.49. And capital ratios look strong. Preliminary Tier 1 common equity was 12.13%.
So solid capital base, returning some cash via buybacks. What about their overall strategy moving forward? What are the key focus areas?
They're aiming for a sort of low to mid single-digit loan growth overall. Within that, they want to grow the C&I portfolio more, while maybe shrinking the CRA portfolio as a percentage of the total. They'll also keep selling residential mortgages, likely to manage capital and interest rate risk. Hiring more bankers is on the list too. And of course, maintaining that strong asset quality.
Any specific geographic focus?
Yes. They highlighted the expansion in the Atlanta metro area. They're really targeting the Korean community there and the manufacturing investments happening in that region.
Which ties right back into that strong deposit growth from USKC clients we talked about.
Exactly. It seems like a core part of their strategy.
Okay, that really paints a detailed picture of the quarter and their plans. So now for the part of the show where we brainstorm some potential market angles. Remember, everyone, this is strictly the not financial advice segment, just some thought experiments. What's an outrageous but plausible trade idea based on this?
All right, here's one angle, playing on that USKC strength. Given how well Hanmi seems to be doing attracting those deposits, especially that huge jump in corporate Korea funds, you could theoretically consider a pair trade. Maybe long Hanmi Financial, assuming it was publicly traded, of course, clearly, and pair that with shorting a regional bank, or maybe a basket of regional banks that operate in similar areas, like maybe Atlanta or other regions with Korean business presence, but haven't shown that same success tapping into that demographic.
So the thesis is Hanmi's niche focus gives it an edge, particularly on the funding side.
Yeah, precisely. If they keep executing on that strategy, especially the Atlanta expansion targeting that community, they might continue to outperform peers who don't have that specific connection or focus. Of course, it's highly speculative, depends on a lot of things. Geopolitics, trade stability with South Korea, and Hanmi actually keeping up that execution.
Interesting. Definitely leverages their specific strength. What's another idea? Maybe looking broader.
Okay. Idea number 2 is a bit more macro, thinking about the potential slowing of that net interest margin expansion we discussed. Not just for Hanmi, but maybe for the sector.
Right, if competition for deposits heats up or funding costs rise generally.
Exactly. So you could consider a broader bearish view on regional banks, maybe using an ETF like KRE or something similar, but you'd hedge that. You could pair the short regional bank position with a long position in companies that provide tech solutions for banks.
Tech solutions for what specifically?
Things like deposit gathering optimization, customer retention tools, digital banking platforms, basically, the tech that helps banks compete more effectively and potentially manage those margin pressures. The idea is that margin headwinds could pressure the whole sector, but banks leveraging technology better might hold up, and the tech providers themselves would benefit.
So, betting against the broad sector pressure, but betting on the tools that might help navigate it.
Sort of, yeah. Hanmi's relationship banking might give them some defense, but the wider sector could face challenges, and technology adoption might be key. Again, just a thought experiment.
Absolutely. Two very different but thought-provoking angles there. And just to reiterate one last time, these are purely hypothetical ideas for discussion. Absolutely not financial advice.
Yeah.
Always do your own homework.
Couldn't agree more. So that wraps up our deep dive into Hanmi Financial's Q1 2025 earnings call. We hit the key financials, management's perspective, the strategic outlook.
And those trade ideas. Hopefully this gave you a good handle on the quarter. What stood out most to you listening in? Any questions still lingering? We always encourage you to dig deeper yourself. Thanks for tuning in to Talk Tickers.